In the first quarter of 2026, RenaissanceRe reported an operating return on equity of 21.8%, pushing its tangible book value per share to $233.49. Yet, the market is pricing the equity of this business at a distressed 7.5 times earnings. Institutional markets are aggressively discounting these record returns because they operate on a specific assumption, that RenaissanceRe is currently sitting at the absolute peak of a pricing cycle. The primary bear thesis argues that the property catastrophe hard market has officially ended, and that underwriting margins will inevitably compress as a massive glut of global capital floods back into the reinsurance sector. A secondary thesis points to the firm's $2.98 billion acquisition of Validus Re, suggesting RenaissanceRe is sitting on a potential casualty reserve deficit tied to legacy liability exposures. The competing bull thesis counters that the company has built a structural moat through its capital partners division, generating a stream of fee income that theoretically insulates the balance sheet from these cycle turns. Further complicating the math is the implementation of Bermuda's 15% corporate income tax. This new regime creates a permanent drag on retained earnings, making historical return comparisons largely obsolete. To determine if the stock, currently trading around 1.27 times tangible book value, is a structural compounder or a cyclical value trap, we have to deconstruct its three specific profit engines. The most immediate test of the cycle came during the January 1, 2026 renewals, where risk-adjusted property catastrophe rates fell between 10% and 20%. This chart visualizes the macroeconomic driver behind that drop. We see the rising volume of industry capital, an overwhelming $838 billion supply, intersecting with and driving down the risk-adjusted rate on line. This environment creates a lose-lose-lose dynamic, where soar unit margins compress across the entire reinsurance sector. Providers are accepting less premium for the exact same amount of theoretical exposure. However, looking at this visualization of a standard insurance tower, we can see the industry's structural defense. While reinsurers sacrificed rate, they successfully held their ground on attachment points. The line where reinsurance coverage kicks in remained firm near the top layer. Because that attachment point held, primary insurance carriers are forced to retain all the high-frequency volatility, events like severe convective storms and regional hail. This leaves RenaissanceRe safely at the top of the structure, exclusively underwriting low-probability, high-severity tail risk. The actual exposures they are retaining are catastrophic, peak peril events, such as a major landfalling hurricane causing billions in concentrated regional damage. By shedding frequency risk, the industry has established a structurally higher floor on profitability. Even with headline rates dropping, a reversion to the dismal soft market returns of the 2013 to 2017 era is highly unlikely. The bullish narrative surrounding RenaissanceRe often labels it the black rock of risk, suggesting it has evolved into a high-multiple, capital-light asset manager. This claim is anchored by the company's Capital Partners unit, which oversees $14.9 billion in third-party capital through joint ventures like DaVinci and Vermeer. This flow diagram maps their gross-to-net strategy. RenaissanceRe retains approximately 50% of its assumed property catastrophe premiums on its own corporate balance sheet, while ceding the remaining half to these managed vehicles. By sharing that risk, they generate substantial revenue for managing the capital, bringing in $94.1 million in fee income during the first quarter of 2026 alone. But looking at this isolated $94.1 million block, we can break apart this stable annuity illusion. The total is bifurcated into two distinct categories, roughly $48 million in management fees and $46 million in performance fees. The base management fees are relatively stable, consistently hovering between $46 million and $56 million on a quarterly basis. The performance fees, however, are extremely cyclical. During the first quarter of 2025, severe California wildfires drove performance fees down to negative $15.6 million. Furthermore, the third-party capital backing these vehicles is highly mobile. Unlike a permanent capital vehicle, these institutional investors can and do withdraw their funds. In the first quarter of 2026, the unit recorded $912.8 million in net outflows, as investors actively rebalanced their portfolios and took profits. The fee structure is an excellent cyclical shock absorber, but it is not immune to gravity. During a severe market softening, performance fees will compress and assets under management will shrink, proving the firm is still a leveraged reinsurer, not a pure asset manager. The largest recognized threat to the company's tangible book value lies in the legacy casualty exposures acquired through the $2.98 billion Validus transaction. This book of business is highly sensitive to social inflation. Driven heavily by aggressive litigation financing, the median liability court award surged 23% in 2025. This financial data table for the casualty and specialty segment shows the resulting strain. In late 2025, the combined ratio breached the break-even point, hitting 101.4% in the third quarter and 103.5% in the fourth. Posting an underwriting loss during a structurally hard casualty market is a major red flag. It usually indicates that claims are outpacing collected premiums, hinting at a massive underlying reserve deficiency. But we have to filter out the statutory noise. The segment reported 0.4% to 0.5% of adverse prior year development, but this drag was explicitly driven by non-economic purchase accounting adjustments related to the acquisition itself, not actual claims blowing up. More importantly, RenaissanceRe secured structural protection during the acquisition, a 95% adverse development cover provided by AIG. This retroactive agreement effectively requires AIG to absorb the vast majority of any reserve deterioration, shielding RenaissanceRe's tangible book value from the toxic pre-acquisition Validus vintages. The real, unshielded operational risk lies entirely in the pricing adequacy of the newer 2024 to 2026 casualty vintages, currently being underwritten by the combined entity. Recognizing this, management took a defensive posture in early 2026, actively shrinking their general casualty gross premiums by 26.4%. The legacy Validus time bomb is largely neutralized by the AIG shield. However, the persistence of social inflation means they must maintain extreme underwriting discipline on new business to prevent future reserve charges. This brings us to management's capital allocation strategy, specifically their aggressive share repurchases in the first quarter of 2026. The company actively bought back its own stock at roughly 1.27 times tangible book value. This formula layout calculates the mechanical consequence of that decision. Buying 1.2 million shares at $289.36 against a starting tangible book value of $230.10 results in an immediate mathematical dilution of about 0.7%. The justification for taking that dilution is the firm's 21.8% operating return on equity. At that rate of compounding, the lost book value is effectively filled back in within a few weeks of normal operations. The specific risk to this strategy is clear. If that return on equity collapses, whether from softening property rates or sudden casualty deterioration, those buybacks will have permanently destroyed capital. For an investor strictly optimizing for absolute tangible book value compounding, repurchases at a premium are only accretive if management can sustain a mid-teens operating return across the entire cycle. This probability-weighted matrix synthesizes these variables for a fair expected value. We assign a 50% probability to the base case. Pricing discipline and stabilized fees justify a 1.25 multiple and a $320 target. A 30% probability goes to the bear case. Capital floods the market, casualty reserves weaken, and returns drop, punishing the stock to a 0.95 multiple and a $200 target. Looking back at our matrix, we assign the final 20% probability to the bull case. Terms remain tight and returns stay elevated, pushing the multiple to 1.40 for a $375 target. Weighting these rows outputs a final expected value of roughly $295. Hitting that bear case target likely requires a severe, capital-impairing catastrophic event arriving at the exact same time as a failure in their reserve methodology. That mathematically derived expected value is effectively identical to the stock's current trading price. Therefore, the definitive institutional verdict for current holders is to maintain the position. RenaissanceRe is a best-in-class franchise, but paying 1.27 times tangible book value leaves zero margin of safety as the reinsurance cycle begins to soften. Investors should hold their ground and wait to deploy fresh capital until an asymmetric entry point near 1.10 times tangible book value materializes.